If you have a sum of money you intend to invest, how should you allocate it? Should you invest it all at once or chunk it out over time? Which approach will yield better long-term returns? In today's video, we're going to explore this topic. First, let's look at the case where the investment capital is fixed, for example, 200,000 Australian dollars. How should you invest it? Here's a chart. It spans from June 2007 to June 2025, covering 18 years. The chart shows 4 lines, each representing a different investment approach. Lump sum, LS, dollar cost averaging, DCA, by the DIP, BTD, and a combination of DCA and BTD, which we'll call DCA plus BTD. Specifically, lump sum, LS, means investing the entire 200,000 Australian dollars at once in June 2007 and then holding it, buy and hold. We chose this start date to observe the effect of entering at a market peak and then experiencing at least 3 bear market declines. The second method is dollar cost averaging, DCA, starting in June 2007. You invest the same amount each month and take 2 years to invest the full 200,000 Australian dollars. Since 2 years is 24 months, that works out to about $8,333 per month. Note that you could adjust this time frame to 3 or 5 years, depending on the strategy and market environment. In this example, we're using a 2-year horizon. The third strategy is to buy the dip, BTD. In this example, the specific BTD strategy we apply is starting June 2007. Whenever the market falls by 5% in a month, you invest $8,333. For every additional 5% drop, you invest another $8,333, continuing until the full $200,000 is invested. The fourth combines DCA and BTD. You invest $8,333 Australian dollars every month. And if there's a dip that meets the BTD criteria, you add another $8,333 that month, continuing until the entire $200,000 is invested. Looking at the final results, DCA delivers the highest total return, while LS yields the lowest. Does that mean DCA is definitively the best strategy? Not necessarily. Let's dive deeper to understand why. From the chart, in a bear market entry scenario, the green line, the DCA plus BTD strategy grows the fastest initially. This method combines monthly investing with opportunistic buying. So during the early bear market, you make the most contributions, boosting early net asset growth. But because this strategy invests most of the money too early, before the bear market is over, ends up going through a major drawdown while fully invested, and its final return slightly trails out of the more gradual DCA. As for LS, its performance is straightforward. Investing all the money at the onset of a bear market maximizes risk exposure. The subsequent market downturn causes a steep drawdown that takes a long time to recover, leaving LS as the laggard among the 4. Consider the BTD strategy. Although its end value trails DCA, it achieves the highest XIRR of all strategies. This shows it's extremely capital efficient, which means the highest annualized return per unit of invested capital. In other words, BTD is a maximal return per dollar strategy. That's why BTD outperforms LS in later returns. However, BTD's success depends heavily on strategy design, such as defining the dip threshold. If you set it too strict, like the 5% monthly drop in this case, you might miss many buying opportunities and leave capital idle, weakening compounding. If it's too loose, you lose timing advantages. Thus, BTD is timing heavy and better suited for investors with higher risk tolerance and market judgment skills. A well-designed BTD can outperform in a bear market. DCA performs better because it spreads the investments across the entire bear market, effectively averaging down the entry cost. In this scenario, the final DCA contribution is made in May 2009, right around the market bottom and the beginning of the next bull run. Having fully deployed the capital just as the rebound starts allows the portfolio to capture the full upside of the recovery. From this perspective, the weakness of the DCA plus BTD strategy lies in deploying funds too quickly. Most of the capital is invested before the bear market ends. In contrast, pure BTD takes the opposite risk, being too conservative and leaving too much capital on the sidelines. These two approaches represent the extremes of overinvestment and underinvestment during a downturn. Looking at the data, it might seem like the ideal strategy is to invest everything just before a bull market starts. But in reality, that's almost impossible to pull off. We can't predict when a bull market begins or where we are in the bear cycle. Most investors simply can't time the market, and trying to do so often backfires. I talked about the cost of market timing in a previous video. Check the link if you're interested. So if the ideal strategy can't be executed, what should we do instead? Rather than chasing perfect timing, focus on building a steady rhythm. For most investors, simple and consistent DCA works best. Why not BTD? Because it requires strict entry rules and the courage to buy during dips, which is not easy for the average investor. DCA doesn't rely on any market calls. It's all about following a schedule, smoothing out the cost, and gradually building the position. So, how do you choose the right DCA period? We can look at historical data to guide our planning. Based on the past 100 years of U.S. stock market history, the average bear market lasts about 245 trading days, and the median is around 219 days, which translates to roughly 1 year in real time. That's why I suggest setting the DCA period to around 2 or even 3 years. Take it slow, don't rush the pace. This way, if the downturn lasts longer than expected, you won't run out of ammo too early. And if the bull market returns sooner than expected, you can always invest the remaining funds in a lump sum to fully ride the upside. Let's look at another scenario. Suppose the initial investment starts in March 2009, right at the beginning of the bull market, while keeping all other conditions the same. In this case, it's clear that LS has an overwhelming advantage over the other three strategies. The reason is simple. During a bull market, a lump sum investment captures the full upside, whereas phased investments incur opportunity costs. This is also reflected in the end value. LS ends up with nearly 3 times the value of BTD. That's because in a bull market, there are fewer opportunities to buy the dip. Over the 16-year backtest period, the BTD strategy only triggered 18 contributions, with long gaps between each one. That significantly weakens the power of compounding. So in a bull run, your best move is to stay put and not mess around with your portfolio too much. Next, let's talk about scenarios where there's no cap on how much you can invest. For example, say you currently have $200,000 ready to invest, and you also have a stable cash flow that allows you to continue investing in the future. This probably reflects how most people invest in real life. Let's go back to the same backtest from June 2007 to June 2025, where all 4 strategies start with an initial investment of $200,000. The 3 phase strategies invest $2,000 per contribution. DCA results in 216 months of investing, totaling $632,000. BTD triggered 62 dip buys, totaling $324,000. DCA plus BTD made 279 investments, totaling $758,000. The compound annual growth rates are roughly similar across all 4, with LS slightly ahead. Since DCA plus BTD invested the most, it ends up with the highest final value. Now let's apply the same setup starting from the end of the bear market in 2009. The differences in returns become much more pronounced. LS achieves a compound annual return of nearly 14%, while DCA plus BTD lags at 10%. That's because continuous investing during a bull market increases the average cost base, making the return rate appear lower. Since DCA plus BTD involve the largest total investment, it has the lowest annualized return. However, as long as the investment horizon is long enough, bull and bear cycles will average out, and the long-term return will converge toward the market average. More importantly, over the long run, final wealth is driven by the compounding effect. The more you invest early, the more powerful compounding becomes. That's why, despite its lower return rate, DCA plus BTD still ends up with the highest final value. It's simply put the most money to work. From this, we can see that wealth accumulation hinges on 2 core factors: consistent contributions, and the amplifying power of compounding. You can't have one without the other. Many people focus solely on return rates while overlooking the importance of steadily adding capital. But real long-term wealth growth comes from persistently investing and letting time and compounding do the heavy lifting. Also, don't be afraid of bear markets. They're actually powerful accelerators for wealth building. Increasing the investments during market downturns may not pay off immediately, but once the market rebounds, those low-entry assets can generate exponential gains. Based on everything we've discussed, whether you're investing a fixed amount or contributing as much as possible over time, DCA is the most suitable strategy for most investors. It's simple, reliable, and doesn't depend on market predictions. It's the foundation for building long-term wealth. If you have ample capital and some ability to read market trends, you can consider using BTD as a supplementary strategy, adding to the position during panic sell-offs or sharp declines to further boost compounding. For most investors, the key is to keep investing consistently, increase the capital contributions as much as you can, and maintain a regular schedule without being thrown off by market swings. In particular, when markets are in extreme fear, that's often the best time to step up. Staying disciplined, adding steadily, and buying when others are fearful, that's the simplest and most effective way to build long-term wealth. If you found this content helpful, don't forget to subscribe, like, and share. I'll see you in the next one.